In previous videos, we spoke about double top, double bottom patterns, head and shoulders, reverse head and shoulders patterns, triangles. In this video, we're going to review channels and wedges. Let's get started. Channel patterns are defined by two parallel resistance and support lines that guide the price movement within a channel. These patterns come in three variations. We'll start with the ascending channel. In these patterns, the top forms higher highs and the bottom side forms higher lows, creating two upward-sloping parallel trend lines. These lines guide the price as it moves within this channel, making higher highs and higher lows. In a bullish ascending channel, the price is in an uptrend and the pattern forms as the price continues to climb. The higher highs and higher lows suggest that the uptrend is intact, and you can look for buying opportunities along the lower trend line, the support, or breakouts above the support resistance trend line. In a bearish ascending channel, the price begins in a downtrend, and while it appears to be climbing, the channel formation indicates a potential continuation of a downward movement. This can be the signal to prepare for a bearish breakout or reversal. Next, we have the descending channel. Here, the top side form lower highs and the bottom side form lower lows, creating two downward-sloping parallel trend lines. The price moves within this channel gradually, making lower highs and lower lows. In a bullish descending channel, the price starts in an uptrend, but the formation of the descending channel suggests a temporary pullback. Traders often look for buying opportunities when the price breaks out above the descending trend line, signaling a continuation of the trend. In a bearish descending channel, the price begins in a downtrend, and the channel formation confirms the downwards momentum is still in place. Lower highs and lower lows indicates that sellers are in control, and traders may look for opportunities to short the market, especially when the price breaks below the descending trend line. Finally, we have the horizontal channel, also known as a range-bound market. In this variation, the top side form consistent highs, creating an horizontal resistance level, while the bottom side forms consistent lows, establishing a horizontal support level. The price moves sideways between these two parallel levels. In a bullish horizontal channel, the price starts in an uptrend but consolidate within a range. This often indicates that the market is taking a breather before continuing its upward momentum. Traders can look for breakouts of the horizontal resistance to confirm the continuation of the uptrend. In a bearish horizontal channel, the price starts in a downtrend and consolidates within this range. The pattern indicates a pause in the downtrend, but if the price breaks below the horizontal support, it signals a continuation of the bearish movement. Each of these channel patterns, ascending, descending, horizontal, provides you with opportunities to identify trends and potential breakouts, whether the market is moving upwards, downwards, or sideways. By understanding how the price reacts to these channels, you can plan your entries and your exit more efficiently. Now, let's move on to the wedge pattern, which comes in two variations, the rising wedge and the falling wedge. Wedge patterns are unique because the two trend lines that form the wedge converge, signaling a potential breakouts as the price movement tightens. The first variation is the rising wedge. In this pattern, both the top side and the bottom side are moving upward, with the top forming higher highs and the bottom forming higher lows. However, the key characteristics of a rising wedge is that the two trend lines are converging, meaning the range between the low and the high is getting smaller. In a bullish rising wedge, the price is initially in an uptrend, and the rising wedge forms as a continuation pattern. But be cautious. While it can break out to the upside, a rising wedge often signals a reversal. If the price breaks below the lower trend line, it confirms a bearish reversal. Even though the overall market may still appear bullish in a bearish rising wedge, the price starts in a downtrend. The rising wedge pattern forms during a pullback, but the price is likely to break out below the bottom trend line, continuing the bearish momentum. Next, we have the falling wedge. This time, both the top side and the bottom side are sloping downward. The top side form lower highs, and the bottom side form lower lows. But just like the rising wedge, the trend lines are converging, indicating a potential breakout. In a bullish falling wedge, the price is in an uptrend and the falling wedge forms as a consolidation or a retracement. The tightening price range suggests that a breakout is imminent, and when the price breaks above the upper trend line, it signals a continuation of the trend. In a bearish falling wedge, the price starts in a downtrend and the wedge forms as part of a consolidation phase. The price may continue downward, but the falling wedge typically signals an impending reversal. A breakout above the upper trend line would confirm a bullish reversal. In the next video, we'll discuss how to use triangles, channels, and wedges in your trading strategy.